Negative gearing and capital gains tax changes are not just a tax story. They are a real estate story. Because tax rules do not sit in isolation. They affect buyer confidence, they affect investor demand, they affect rental supply, they affect off-the-plan sales, and they affect what people are prepared to pay. The first point is important. Existing investors are largely protected. If you already owned an investment property before the budget announcement or had already exchanged contracts, the existing negative gearing rules continue until that property is sold. This is not about wiping out existing investors. The real impact is on future purchasers, particularly investors buying established rental properties. Let me give you a simple example. An investor buys a $1 million apartment in Sydney, but the real cost is not $1 million. Once you add stamp duty, the starting cost is closer to $1.04 million. Now let's say the property rents for $900 a week. That sounds strong. But once you add interest, strata levies, rates, insurance, repairs, and other costs, that property may still be losing around $23,000 a year. Under the old system, that loss could reduce the investor's taxable income. Under the new system, for future purchases of established properties, that immediate tax benefit may no longer be available. That changes the entire cash flow equation, and capital gains tax is changing too. Instead of simply applying the 50% CGT discount, the new system looks more closely at the real gain after inflation. So if a property has no growth for 3 years, then only grows at 3% per year, the capital gain may not be as strong. Once inflation, stamp duty, and holding costs are included. That is why this matters. The question is no longer just, what tax benefit do I get? The question is, does the property stand on its own? Is the rent strong enough? Are the strata levies manageable? Will the property genuinely outperform inflation? And can investors trust that the rules will not change again? This is where real estate experience matters. Because a tax change may be written in Canberra, but its effect is felt in the market by buyers, sellers, landlords, and tenants. In real estate, the numbers always tell the story.